Most investors think buy now, pay later is just a feature, a convenient way to split payments. But what if that assumption is completely wrong? What if BNPL is not a feature, but the early layer of a new financial system? And what if Affirm is quietly positioning itself at the center of it? To understand Affirm, you have to ask a different question. Not what does the company do, but what is it becoming? Because on the surface, Affirm looks simple, a fintech company that lets consumers split payments over time. But under the surface, it's building something much more complex, a system that sits between consumers, merchants, and capital markets. And if that system works, it doesn't just compete with credit cards, it starts to replace them. Let's start with the obvious. Affirm offers pay in 4 products, installment loans, interest-free and interest-bearing financing. But that's not the story. The real story is how it's structured. No late fees, no compounding interest, no hidden pricing. That's not just a product decision, it's a strategic positioning choice because traditional credit relies on confusion. Affirm is trying to win with transparency, and in financial services, that changes user behavior. Affirm is not just a lender, it's a network. On one side, over 25 million consumers. On the other, hundreds of thousands of merchants, and the interaction between the two creates a flywheel. More consumers lead to attract more merchants. More merchants lead to better offers. Better offers lead to more usage. But here's the key insight. This is not just a network effect, it's a data network effect. Every transaction improves underwriting. Every repayment improves pricing. And over time, this creates a system that becomes increasingly difficult to replicate. Traditional lenders underwrite the person. Affirm underwrites the transaction. That sounds subtle, but it changes everything. Instead of asking, is this borrower risky? Affirm asks, is this purchase at this moment for this user acceptable risk? That allows dynamic pricing, real-time decision-making, and better risk-adjusted returns. And as data compounds, this advantage becomes structural. The company also leverages proprietary data feeds from direct merchant integrations to gain unique transaction-level insights that enhance risk assessment and user experience. Adapt AI further leverages these capabilities, using AI to deliver real-time tailored offers that boost merchant conversions and consumer satisfaction. Most investors still think of Affirm as a checkout tool, something you use occasionally, but the company is moving towards something else entirely. Daily financial usage via high-yield savings accounts, merchant solutions. The Affirm card is the key. It allows users to pay now or split later at any merchant. This changes the model from point-of-sale financing to everyday financial layer. And that shift matters because frequency drives value, and value drives retention. As of December 31st, 2025, Affirm had 25.8 million active consumers and 478,000 active merchants, ranging from small businesses to large enterprises across diverse industries. The company primarily operates in the US and Canada, but in November 2024, Affirm also launched in the UK. This progress underpins the ambitious long-term vision of becoming the world's largest bank via a daily used financial platform featuring savings accounts, investments, and further innovation. Affirm doesn't rely on users finding it. It embeds itself strategically where transactions already happen. Shopify, Amazon, Apple Pay, Expedia, Intuit. These are not just partnerships. They are actually distribution channels. And distribution at this scale is hard to replicate. Instead of acquiring users one by one, Affirm plugs into ecosystems that already have them. In addition to these partnerships, payment service providers and independent software vendors have become crucial distribution channels for Affirm. Now let's talk numbers. Affirm reported stellar operating results in Q2 2026. Gross merchandise volume increased to $13.8 billion US. This is a 36% YOY change. GMV growth accelerated, driven by direct merchant point-of-sale integrations, direct-to-consumer business led by Affirm Card and growth from wallet partnerships. Active cardholder count increased by 121% to 3.7 million with a 14% card attach rate. The card attach rate is defined as active cardholders divided by total active consumers during a given period. The number of active consumers grew by 23% to 25.8 million in the same period. That indicates Affirm is gaining momentum by growing cardholder count faster than the base. The number of transactions per active consumer rose to 6.4 in Q2 2026 compared to 5.3 in Q2 2025, driven by improving engagement and the stickiness of the platform. And finally, the number of active merchants increased to 478,000 in Q2 2026. This is a 42% YOY change. That indicates sustained expansion of Affirm's merchant network. Merchants with over $1,000 in trailing 12-month GMV expanded at a similar pace, reaching to 193,000. Affirm is growing fast, GMV expanding strongly, user base increasing, engagement improving, and importantly, Affirm has recently turned profitable on a GAAP and normalized basis in FY 2025. Now let's talk analyst expectations. Wall Street analysts project Affirm's revenue to more than double by fiscal year 2030. Normalized EPS is expected to grow exponentially in the next several years, compounding at 98.4% until fiscal year 2030. Free cash flow is expected to more than triple and compound at 25.4% until fiscal year 2030. Wall Street analysts' expectations present a solid growth trajectory in the near future. Furthermore, today, funding costs are improving, margins are stabilizing, and operating leverage is starting to show, yet valuation remains relatively compressed compared to its history. The company's current NTM-PE ratio is 12.7 times, which is far below its historical range, with a mean of 32.1 times. This discount creates a tension: strong growth, but limited multiple expansion. This is where the story gets more complex. First, competition. Affirm had been Walmart's exclusive BNPL partner since 2019, and the company disclosed that this program accounted for approximately 5% of its GMV in the 6 months through December 2024. Losing the Walmart partnership showed that even major relationships are not permanent. Second, credit risk. In Q2 2026, Affirm's 30-day plus delinquencies rose to 2.7%, the highest level in 6 years, increasing both year-over-year and quarter-over-quarter. While the company maintains that its delinquency performance remains favorable relative to peer consumer lenders, the deterioration warrants close monitoring. Third, macro exposure. Macroeconomic factors, including consumer spending, consumer credit performance, and capital market liquidity, pose significant risks to Affirm's business. And in weaker environments, these macro factors easily become constraints. On the other hand, economic downturns may temporarily slow GMV growth, but its core offering could become more vital during tough times, potentially driving long-term growth despite short-term fluctuations. Finally, regulation. If Affirm evolves into a bank, its flexibility could decrease. Both growth and profitability may be affected by increasing compliance costs and approval timelines. Once again, the same question. What is Affirm? A lender, a payments company, or something else? The most interesting interpretation is this: Affirm is building a financial layer that sits between consumers, merchants, and capital. If it succeeds, it doesn't just participate in transactions, it orchestrates them. The opportunity is significant, the risks are real, and the outcome is still uncertain. But we are not lost in a stormy sea. GMV growth, card adoption, delinquency trends, and key partnership retention will signal which scenario plays out. We, as Capital Insight Lab, will monitor these key metrics and more to provide timely insight to investors.